Hey, thanks for coming to my video today. I wanted to put out this video to talk about the differences between building a software company with bootstrapping as an initial financing strategy versus doing something like venture capital. And this is something that I really didn't understand early on in my entrepreneurship career. And I wish somebody had explained it to me a little bit better. So the thing about bootstrapping versus venture capital is one, you really need to understand your end goal. What's your overall strategy? What's your exit strategy for your company? Because when you're starting a business, you have to know why you're doing it. Are you doing it just to generate some lifestyle income? Are you doing it to build a profitable company that employs lots of people and generates you some wealth? Or are you really looking to knock it out of the park, build the next unicorn, have the next billion-dollar company, or whatever it happens to be? Because based on answering that question, you're going to be able to match the financing strategy to your company the way that you need to. If you want to go and you want to build a company with venture capital, you have to understand the economics of the venture capital business. Venture capital raises money from their limited partners in order to generate, let's call it on average, a 20%. It's called an IRR, internal rate of return, over a long enough period of time. So they'll invest money into the fund, and then after 5 to 7 years, the hope is, first, that they'll get all the money back. Second is that they'll generate a higher enough rate of return to outpace the S&P and outpace other forms of investments. So let's say that looks like 20% IRR. Now, what that means for you as a company that is receiving venture capital investment is that out of all of the companies that they're investing in, let's say it's 10, let's say it's 100 companies, they know that only a couple companies are going to become extremely large. So that might be a $100 million valuation, that might be $1 billion valuation, or even more. And most companies that they invest in are not going to generate a return of even the capital that's invested. Most of them are likely going to fail. Some of them are going to break even and not maybe return the investment that they made, but not generate too much of a return on top. And then some are going to be some okay, let's call it a double in baseball terms. So when you have the math behind that, and they're expecting that, let's say, 1 out of 10 companies is going to be a massive return, that 1 out of 10 company is going to generate the return for the entire portfolio effectively and cover all of the losses that are put in. So that impacts how they interact with your company as a portfolio company in the venture capital space. So if you receive a venture capital investment, for the most part, you're going to be acting, depending on how the terms are, as an employee of the fund, where they can just come in. If they've got board control, they can just come and shut you down if it's not in their strategic best interest to have you continue operating. Let's say you're not hitting your milestones or your goals or whatever. They would also have the ability to go and kick you out of the CEO seat or as a founder because they don't necessarily like the performance that you're yielding. So because of that, you're under an extreme amount of pressure to generate really solid returns and hit milestones that may even be unrealistic. So you have to understand that even in the venture capital world, just being a profitable company isn't something that is that exciting for them, because you might be a profitable company, but if you're not generating a large return for them in terms of equity valuation, it may just not even be interesting to them because it may not satisfy the needs of their limited partners. So you could build a company doing $3 million a year in annual recurring revenue. You've got a 30% gross margin, but if you don't have a path to get to 30 million, 50 million, or 100 million, you might be looked at as kind of a write-off, if you want to call it, in the venture capital space. And then you enter this phase where you're called like a zombie startup, where you're generating good cash flow, but you're never going to grow. So that's going to impact your decision as a founder on what you do with the company moving forward and what level of control that you have and all that stuff. So obviously I'm painting a broad brush, and there are exceptions to this. It really all depends on the term sheets and deals that you sign and all that sort of stuff. But that also depends on how much leverage you have going into the deal to begin with. If you are generating a substantial amount of traction. You've got a lot more potential upside when you sign into it. You might be a little bit or a better negotiator. You might be able to negotiate better terms in terms of control. So let's contrast that with bootstrapping. If you bootstrap a company, you maintain, let's call it 100% control of your company from day one. Obviously, if you bring in business partners, co-founders, or you give equity early on, that's a different story, but you're dividing the pool in a different way based on sweat equity or whether or not you invest your own capital into it. So what this means that as your company grows, you maintain additional control over the cash flows of the company, you maintain control over the balance sheet, you maintain control of the cap table and the voting structure, the board of directors, and all of that. So you ultimately decide whether or not to grow or not grow or make investments to do whatever you want. Now, this is a good thing if you get to a place where you've got profitability and you're able to kick out a lot of cash flow for the company and generate great, it's called lifestyle for yourself, where you're able to pay yourself a great salary as a founder, get your money back that you invested in the company originally, hopefully, or even grow it from there, or even get to the point where you actually sell your company. Maybe not for $1 billion valuation, but you receive an offer for $10 million from some private equity fund or strategic acquirer, and then you're able to get the majority of the returns that come from that sale rather than have to give up a large percentage of it away. Because sometimes even, I've heard horror stories, if you raise venture capital, you even get to this $1 billion exit or whatever number that sounds really good on paper, but you as a founder might get very little or if any. I've heard stories of some founders actually getting nothing after a very large exit because of the way that their milestones were structured. They actually got pushed out equity-wise of the company to make all of the other investors that came in get paid out first, and then the founder got left with nothing. So just because you actually produce a large success in venture capital does not necessarily mean that you're going to get a return from that. With bootstrapping, you have more control over your universe with that. So the downside of that is you don't have uncapped growth capital, at least initially, in order to go and hit your goals and milestones. But you can go and get that through other ways, either through pre-selling to customers, you can raise friends and family rounds, you can do other types of angel investments on people that are more interested in the kind of strategy that you're looking to do. So at the end of the day, bootstrapping gives you a lot more control and a lot more flexibility, with the exception that you can't really go and just burn incessantly to find your product market fit and get to that kind of growth phase. So now, but once you do bootstrap and once you do find product market fit and you do generate some solid traction, it might actually be a lot easier for you to go raise money on better terms that you can use to grow the company and fund customer acquisition and all that. So, and again, it also depends too on the space that you're going into. One of the things that I really didn't understand early on, but I learned later on, was if you're building a piece of software that does not require a lot of tech investment on the front end, maybe a little bit more of a marketing opportunity where you go after it, you can generate some revenue from it, but it's not going to require a lot of technical innovation or tech debt, if you want to call it that. You can generate a lot of revenue without having to invest a lot of capital up front in building your business. But as an example, when I originally went into the webinar space, I had underestimated how much capital it was going to take in order to hit product market fit, because it was such a complicated product to build where there was a lot of moving parts happening at the same time. And ultimately, like, that impacts how much capital you have to invest in order to get to a point where you have product market fit, where people are able to use your product and have it provide value in the marketplace. One actually great way of looking at this is if you look at, let's say, Elon Musk's companies. So one of the terms for this is called deep tech. So deep tech, as an example, would be SpaceX. So they're building rockets and they're trying to do reusable rockets and then send stuff into space and all that. And you obviously couldn't bootstrap a company like that. Like, you need billions of dollars in capital that you can put behind research and development and figuring it out. And then he lights rockets on fire, they blow up. And then before you know it, like after 3, 4, 5 iterations, he figured out the process. So that kind of company, like a deep tech company, is not optimal for doing bootstrapping. So you need to raise a large amount of capital for that, which is way easier when you're someone like Elon, who has access to the capital markets and people trust him because he's got a strong track record of actually delivering results for investors. So when you're first starting out, you're obviously not going to have that, but you want to be more strategic in how you get it if your product requires a lot of research and development in the long term. So yeah, really understanding your market, understanding how much capital it's going to take to get to product market fit, and then ultimately to scale. What's it going to cost to acquire a customer, and then how long does it actually take to get back the capital that you put in for acquiring a customer and to generate profitability on that revenue will tell you your overall cash flow cycle. And then you can then match your balance sheet accordingly to build your company. So those are my key thoughts on building a software company with bootstrapping versus venture capital. You can also, there's some middle of the road paths. You can raise money through private equity typically, but they usually are trying to generate a return for their investors, so they require maybe some more control, but it's more flexible than something like venture capital. And another great strategic investment source is strategic acquirers that are willing to put, let's say customers, they're willing to put money into your company to solve a problem. So it really depends on which problem you're trying to solve and where you're trying to go. But I would say those are some things to think about when you're trying to figure out how to finance your company. If you have any other questions, just drop them in the comments below, and I'm happy to chat through those with you.